Welcome back to the Daily Crypto Roundup. Today, we need to talk about a market that looks calm on the surface, but underneath it is anything but calm. Bitcoin has been clinging to the low 70,000s. Even as inflation has come in hotter on the headline number, oil risks are back on the table because of war. Bhutan appears to be quietly unloading a huge chunk of its sovereign Bitcoin stack. And in Washington, the crypto industry is being reminded that even with momentum on its side, clear legislation is still far from guaranteed. The big theme today is that Bitcoin is holding up, but the reasons it is holding up are getting narrower, more fragile, and more political. Before we get into it, this episode is brought to you by Kraken. If you want a platform that has been around through multiple cycles and is trusted by serious crypto users across the market, Kraken is one of the names worth looking at. If you want to support the show and check them out, use the link in the description. Let's start with the macro picture, because that is still driving the room whether crypto people like it or not. US consumer inflation for March came in at 3.3% year-on-year, with a monthly rise of 0.9%. The important detail is that the pain was driven heavily by energy. Core CPI, which strips out food and energy, was softer at 2.6% year-on-year and 0.2% month-on-month. That is why the market reaction was not a total meltdown. If both headline and core had come in hot, you would probably have seen a much uglier day. Instead, traders got a report that said inflation is still a problem, but not quite a disaster everywhere you look. That softer core number matters because it gave Bitcoin enough room to breathe. Instead of getting smashed straight down, Bitcoin held back above the $72,000 area. That is a strong sign at first glance, because it suggests buyers are still willing to step in even when the Fed story is not giving them much help. But the more interesting question is not just why Bitcoin held, it is who is actually doing the holding. And that is where the story gets more complicated. The Bitcoin market is now effectively splitting into two camps. On one side, you have a handful of institutional or structurally committed buyers. On the other side, you have a much broader group that is either selling, de-risking, or simply stepping away. The market has spent weeks showing that Bitcoin's floor depends on a handful of buyers absorbing what everyone else is trying to sell. That is a very important point, because it tells you this is not broad-based confidence. This is more like a narrow support beam holding up a much wider structure. So who are those buyers? The answer seems to be the usual names. Strategy is still there. Spot Bitcoin ETFs are still there. Large institutional channels that have to allocate or keep products functioning are still there. But the wider market mood is far less healthy than the price suggests. Bitcoin has spent weeks moving in a relatively tight range, roughly around the mid-60s to low 70s, but that stability is masking weak participation and poor sentiment underneath. In other words, the chart looks more confident than the market actually feels. And this is where oil comes back into the story. The inflation number is not just some abstract Federal Reserve issue. Energy is the key transmission mechanism right now. The inflation spike was tied heavily to rising energy costs, while the risk remains that tensions around the Strait of Hormuz could still push oil much higher if flows are disrupted. That matters for crypto because oil moving sharply higher makes headline inflation stickier, and stickier inflation makes rate cuts less likely or slower. And when the market starts thinking rates stay higher for longer, risk assets lose one of their biggest tailwinds. So, Bitcoin right now is doing something quite impressive, but also quite dangerous. It is showing resilience in a macro backdrop that is not especially friendly. The bullish version of that story is simple. Bitcoin is acting like hard money, a digital scarcity asset that people want even while the old system wobbles. The bearish version is also simple. Bitcoin is only holding because the same small cluster of institutional demand keeps stepping in, and if that slows for even a moment, the market could find itself with very little real support underneath. Both readings can be true at once. Now layer Bhutan on top of that, because this is where things get even more interesting. Bhutan's holdings have reportedly fallen from around 13,000 Bitcoin to 3,954 since October 2024, with around $215.7 million moved out this year alone. That is a very big reduction. If those tracked wallets are accurate, Bhutan has effectively sold around 70% of its Bitcoin over roughly 18 months. For a country that became one of the most fascinating sovereign Bitcoin stories because of its mining and hydroelectric strategy, this is not a small portfolio adjustment. It is a major strategic shift in exposure, at least on-chain. The extra twist is the mining angle. The data suggests Bhutan's last tracked mining inflow above $100,000 was more than a year ago, which is why people are now speculating that the country may have stopped mining too. That part is less certain than the selling data. The holdings decline is visible in the tracked wallet data. The mining halt is more of an inference, so the clean way to say it is this. Bhutan appears to be selling heavily, and there are signs its mining activity may have slowed sharply or paused, but the latter has not been officially confirmed. Why does Bhutan matter? Because it feeds directly into the splitting in two market story. If sovereign or quasi-sovereign holders are trimming, while only a narrow group of buyers is supporting price, then Bitcoin's stability becomes more conditional. Bhutan is not big enough on its own to decide the whole market, but it is a signal. It tells you that not every large holder sees this environment as one to sit tight and keep stacking forever. Some are taking chips off the table. Some are monetizing strength. Some may be deciding that in a wartime macro environment, liquidity and flexibility matter more than ideological conviction. Then we get to Washington, where crypto still wants clarity and still cannot quite get it. Wintermute's Ron Hammond puts the odds of the crypto clarity bill passing this year at just 30%. That is not an official probability, obviously, but it is a grounded political judgment from someone close to the policy space. And it lines up with the broader sense that the bill remains stuck in disputes over stablecoin-related rewards, bank opposition, and broader legislative friction, even though there is still meaningful support in some parts of government. This matters more than some traders realize. A lot of people in crypto want to tell themselves that politics is just noise and price is all that matters. But regulation sets the rules of the road for everything from institutional participation to token classification to what products can legally be offered to users. If the Clarity Act stalls again, that means uncertainty stays in place longer. Some projects can live with that. Large pools of capital do not love it. And if even one of the big current buyers in the market is partly waiting on clearer rules before going harder, then delay becomes a market factor, not just a policy factor. There is also something slightly ironic happening here. On one side, Bitcoin is being held up by some of the most institutional demand it has ever seen. On the other side, the legal framework those institutions say they want is still wobbling around in Congress with no guarantee of passage this year. So you have capital acting as though crypto is mature enough to belong in serious portfolios, while policymakers are still arguing over the plumbing. That mismatch is one reason this market feels strong and shaky at the same time. Put all four stories together and a very clear picture emerges. Bitcoin at $72,000 is not the same as Bitcoin at $72,000 in a broad, euphoric bull run. This is a more defensive, narrower, war-aware version of strength. Inflation is still sticky on the headline level. Oil is a live geopolitical threat to macro stability. The market itself appears to be relying on a concentrated set of institutional buyers. Sovereign holders like Bhutan appear to be trimming exposure. And the legislative clarity the industry keeps promising itself is still not close enough to bank on. That does not automatically make the market bearish. In fact, the most frustrating thing for bears right now is that Bitcoin keeps refusing to break in the way the macro setup says it should. But that resilience should not be confused with safety. A market can hold up and still be fragile. A market can look stable and still be dangerously dependent on a few pipes of demand. A market can trade like digital gold one week and like a leveraged risk asset the next. And that is really the message today. Bitcoin is surviving this environment, but survival is not the same thing as broad conviction. So the way I would frame today's roundup is this. Bitcoin is not being driven by one clean narrative. It is being pulled in four directions at once. Macro says be careful. Oil says things can get worse fast. On-chain sovereign behavior says some big holders are cashing out. Politics says the regulatory future is still not locked in. And yet price says the asset still has serious support. That tension is exactly why this market is so difficult to trade and so interesting to watch. And that is where we will leave it for today. A market that looks stable but is really being held together by macro luck, institutional persistence, and hope that Washington eventually gets its act together. Bitcoin is still standing, but the reasons it is still standing deserve a much closer look than a simple price check. Make sure you are following the show, and as always, we will see you at the top.